question, Tyson. Do you predict that retirement will better be suited next year based on interest rates, or will interest rates continue to rise? And maybe we can talk for just a minute about the correlation between the interest rates and the pension lump sum.
Sure. Yeah, there's a couple issues there. So first of all, with the interest rates, it's impossible to predict where interest rates are going in the future. Even though they've gone up over 2% on the second segment rate, which carries the most weight in the lump sum calculation for a Chevron employee with a pension plan that started the company prior to 2008 and who's not on the cash balance plan. It's impossible to predict where they're going, but I was listening to the Federal Reserve Chairman last week, Patrick, and you probably listened to at least a couple clips of it, but that was some pretty aggressive language about the objectives of the Federal Reserve. They are less concerned about employment numbers and the economy from a jobs perspective than they are about curbing inflation. As many of you know, the primary tool we have, or at least our central bank has, to curbing inflation is allowing interest rates to go back up or reducing their balance sheet and selling bonds back onto the open market. They've already done this pretty aggressively up till now, but we still have historically very high interest rates. And they seem committed to keeping us from going back into the late 70s, where inflation was a little bit higher than it was, or that it is right now. And it could take some time for that to happen. So the reality is we don't know, but there's a lot of risk out there. And if you look at historical interest rates are still very low. When you look going back to the 1940s of corporate bond interest rates. They were as high as, I mentioned on the last webinar, Patrick, I think it was 13% for the AAA corporate bond rate back in the early 80s.
Yep.
There's no reason it couldn't go back there or even higher. And we'd be looking back at, I think it's about 4.6% on the second segment rate right now. That would look incredible compared to 13%. So a lot of risk. We may also see more people taking the annuity option on their pension as the lump sum looks less and less favorable. We have to also remember one of the reasons you're getting less lump sum in a rising interest rate environment is because you can invest that money in fixed income investments like bonds and get a higher rate than you could have a year or two ago. That individual, it's an individual case-by-case basis, and we have to run an analysis. And for somebody where it makes sense to retire this year, it might not make sense for the next person that also works at Chevron and has very similar characteristics. So we just have to run the cash flow analysis to put all of this into a plan and develop ideas based on your specific situation.